Yes, tumwasize mutya sagala twonoone nnyo budde yadde ng'abantu abamu tebali ku call. They will find us on the way. Good enough tugenda kuba nga turecordinga. Tugenda kuba nga turecordinga. Olwaleero tugenda kuba nga tutunuulira risk management mu trading ne techniques ezimulimu. In this article we shall discuss three techniques for risk management in trading. Ndowoozaako nja musindika mubawe. Risk protection ky'ekintu kigenda okusooka kye tugenda okutunuulira. Tugenda tutunuulira risk profile ne active trade management. Active trade management. So we're gonna look at active trade management. Active trade management. We're gonna look at risk protection and risk profile. Risk protection, risk profile, I've ever heard of it, but active trade management may be new to you. But it's okay. Let's go into introduction and we learn together. Our introduction to risk management in trading. Trading knowledge, including technical analysis, good strategies, and chart reading are all necessary, but alone are not enough to make you a successful trader. Okay, that risk trading knowledge, the knowledge that you have in trading, the knowledge that you have in trading, including technical analysis and good strategies, chart reading, and all the necessity will not make you a successful trader. So what will make you a successful trader? Today's post will be one of the most important you will ever read. Here I will discuss risk management, because if you apply the risk management strategies, I can guarantee you'll never blow out another trading account, and you might even become a profitable trader. Risk management is the foundation of a successful trading system. We can basically break risk management into three categories. Okay, risk management can be broken into three categories. Number one, we can break it into risk protection. That's number one. Number two, risk profile. Then number three, active trade management. If I were you, I could take notes of this. Okay, so risk management is made of three wings. The first one is risky. The first one is risk protection. Risky protection. Two is risk profile. Risk profile. Three is active trade management. Active trade management. Those are the three things that we have. Those are the three things that we have. Have risk protection, have risk profile, and active trade management. So when you talk about risk management takes all the three. But let's discuss them in detail so that we can see what does each mean. Number one, risk protection. To protect against something, it is necessary to begin with an understanding of what it is that you are protecting against. It is fine to say that protection is being taken against potential loss. Okay, losses are an inevitable part of trading game. We need to accept losses as the cost of doing this business. The world's best traders lose a lot. The underlying root cause of a loss, root cause of a loss in any trading session is the trader's fear and greed. Okay, so when you talk about risk protection, we need to know within risk protection that what are you protecting against? Okay, if you are protecting, what are you protecting against? Most of the time, we say we are protecting our capital. Another time we say that we are protecting against losses. We don't want to make losses. Okay, but at sometimes you need, like when you come in futures you can set a stop loss. You can set a stop loss, but even the stop loss that even the stop loss that you set, this stop loss that you set in futures, it is the stop loss you set in futures. The stop loss you set in futures, we find that you can take out like $1 to $3 with a stop loss. So that's why they're saying that it is inevitable. Okay, it is what? It is inevitable. The underlying root cause of a loss in any trading situation is the trader's greed and fear. The traders' greed and fear is one of the causes of the loss. Fear warns you. Let's start with fear. Fear warns you that something doesn't feel right about what you trade. You took about a trade that you took. You have to figure out what's going wrong. Any fear that does exist works in two ways. There is a fear of missing out, FOMO, missing out of an opportunity. The coin has left me. I've not traded. You see, it has gone far. That is it. FOMO, fear of missing out. Then the protection against each is somewhat different. So the protection against each is different. Let's discuss each in detail. So there is also fear of incurring a major loss. Oze ku tradinga twasettinzemu stop loss osanze coin ekkiridde twasente zo nnyingi. That is a fear of incurring a major loss. Then there is also fear of missing out. So fear, you can get fear in two ways. You can get fear of missing out when you see that the coin is pumping and you feel that you want to do what? You want to form on it. You want to enter that coin. Then there is a major fear of incurring a fear when you find that you didn't put a stop loss, especially those ones in futures, and you see that your coin is taking a lot of money. You understand? So those are the two fears. But each, let's discuss the two in detail. Okay, risk management, protection against fear of missing out an opportunity. How does it affect our trading? The fear of a missed opportunity may result in a premature trade. It may result you to enter the trade that you have not even planned before because you are formally fear of missing out. What most of us do, we are so afraid of missing a profit that we tend to constantly trade too early. You understand? The common mistake is to conclude that a little bit of a wait is no problem because the eventual result will justify it. The common mistake is to conclude that a little bit of what is no problem because the eventual result will justify it. How do you know it's going to be just a short wait? A short wait. That's an assumption. A much bigger problem, however, is the judgment upon which the trade is based may be invalid because that opportunity has not had a chance to fully develop. Something could go wrong. If it does, the position will probably be stopped. You understand? So this fear, the fear of missing out, ojja kulaba ebiseera ebisinga tutunira nnyo missed opportunity. Olaba nga you would have made money on the certain trade, but you haven't. You are afraid of missing a profit that you tend to constantly trade early. Bulijjo badde okimanyi ati coin bwemalawo kyokuwa confirmation, you just enter the trade. This time round ogenza okuzuukuka nga katale kayambuse, you have missed the entry. Kati you are going to form on it. You are going to form on it. So that is the fear of missing out. Okay, fear missing out. The common mistake is to conclude that a little bit of a wait is no problem because the eventual result will justify it. How do you know it's going to be just a short wait? That's an assumption. Okay. A much bigger problem, however, is that the judgment upon which the trade is based may be invalid because that opportunity has not had a chance to fully develop. So you have not developed any stronger judgment. You have not developed any stronger judgment for you to validate this trade. So if you say it's going to get a premature trade, ogenda kutekinga trade nga tofunye clear confirmation because you fear of missing out. To prevent the fear of missing out, unfortunately, there is no mechanical tool that will invariably keep you from trading too early. Protection against the fear of missing out an opportunity is discipline and confidence in your method. So you should develop a method. You should develop a method. For example, you said you should develop a trading plan. You develop a plan that even if you find that you have missed out an opportunity, you wait for the retest. You understand? You wait for that trade to play out itself. Okay? You wait for that trade to play out itself. So you find out that, okay, it is going good. So you find out that you missed an opportunity. And the opportunity that you missed, you find out that you missed the opportunity. And the opportunity that you missed, you need to come for it. So what you needed to do is for you to protect the fear and missing out, it is you to put, that is discipline. You need to put yourself into discipline and you say, this coin has gone as far as this, okay, whatever goes down, up, always goes down. Let me wait for the retest, or let me wait for the retracement. You understand? Let me wait for the retracement so that when this coin retraces, I will take profit at this point here, okay? So I'll take profit this at this point here. How to prevent fear of missing out? Protection against the fear of missing an opportunity is discipline and what? And confidence in your method. So in your method of trading, when I talk about a method of trading, remember we developed a trading strategy. We saw where we can enter the market and where we can exit as well. Now, here they are giving you steps for discipline in trading. Take a direction from the market, not from your hopes, greed or fear. You understand? Look at the market, analyze it, find your demand, find your supply, find your demand, find your supply. So where the market is at that time, where it is, look at and see where is the market at that very time, or where is the market going? Is it going up or it is going down? Then make clear decisions. Your decisions should be upon what you have analyzed, not your fear, not your greed, not your interest. Okay? Not your interest, not your hopes. Analyze the market, find your demand, find your supply. Know in your head that you have to enter the demand zone and you have to go from the supply zone. Now look at where it is. Where is the market right now and where is it going? Don't use your fear, don't use your greed, don't use your hopes that I think it will. No, you do according to your technical analysis. So predefine your risk before taking a trade. Predefine your risk. Predefining your risk here, you can see that we can talk about setting a stop loss. Okay, you trade knowing that this coin may go against you, and you put what? You put a stop. You understand? You cut your losses with hesitation. You cut your losses with the hesitation. You can vary. You can vary your what? You can vary your stop losses. You can vary your stop losses. Use a systematic money management plan. Systematic money management plan twagedde risk management. Netwogera ku capital deployment. How do you invest? If you have $100, for example, you have $100. How do you put the $100 into a trade? And we said you can decide and you say, let me begin with the $5. Then next I'll put 10. Next I'll put 20. Next I'll put 40. You understand? So get 40. Next you put 80. And your capital around here would be over. Okay? This is the 60, 70, this is 75. And here you find out that you are running with 15 only. You understand? So this is the capital management and the capital deployment. So predefine, use a systematic money management plan. This is the money management plan we are talking about. If you have $100, if you have $1,000, what you have $1,000, you have $100, you have $500, you have $600. How are you going to put this? Should you always put your $600 as your first buying amount all the time? Should you put all the 600 as the first buy amount? Or should we invest all the 500 at once? Should we put all the 100 at once? The answer is no. Reason being, the answer is no. Reason being that you have not managed your risk well. You have to manage your risk. Then two, you have confidence. What we are looking at right now is how we can control the fear of missing out. Okay, fear of missing out. How can we control it? Number one, take the direction of the market. Number two, define your risk before you taking a trade. Number three, cut your losses without hesitation. Number four, use a systematic money management plan and make sure that you deploy your capital accordingly. Then you have confidence in your method. Your method makes all the difference in trading. Confidence in your method makes the difference in trading. You cannot make money unless you have total confidence in your methods. But the problem is that you will not have confidence in your methods if you are not making money. To become a consistently profitable trader, you must develop a method that suits your personality. When developing a trading plan, you should understand the logic behind each step. This will boost your confidence and discipline you to follow the plan. Confidence believes in your ability to do something. So your ability to do something will always help you to control the fear of missing out. To be successful in trading, we must have a method with an edge. We need to trade the method long enough, ignoring the results of individual trades to win. This is not possible without total trust in your methods. Losses shouldn't worry you if you have confidence in your trading method. Just take it and move on. Successful trading is not total avoiding losses, but winning more than what you lose. For every trade we enter, there could be 4 outcomes: big loss, small win, and big win. Let us remove the big loss from this. Small wins will take care of your small losses, and big wins will remain with us. Ensure that your trading plan eliminates the possibility of losing big. You understand? You can't make money if you are not willing to lose. It's like breathing in, but not willing to breathe out. You understand? So you can, if what you are here, if you are looking at your trading method, if you look at your trading method, number one, you have to eliminate big losses. Eliminate big losses. Eliminate big losses. If you have to eliminate big losses, you have to eliminate big losses. If you are to eliminate big losses, number one, make sure that you remove big losses from your account. Big losses will always be removed if you set a stop loss. We are in futures trading. If you set a stop loss, you will avoid the big losses. If you set a stop loss, you will avoid the big losses in futures trading. Okay. If you don't put a stop loss, you will incur big losses. You will incur big losses. You will incur big losses. Now, what you should do when it comes to futures trading, most of the time, losses are inevitable. I told you, newcomers, newbies in the business, don't trade futures. I mean it. Don't trade futures. Okay? And I mean it. Don't trade futures. Let's see. All right, let's rally. Don't trade what? Don't trade futures. If you are new. Only 12 people are here. Which time suits this class? Is it should the class be put at 9 during the day, in the morning, or we leave it at 6? Because the reason why we changed the evening class, that most people don't attend that class. What about this class? Should we also transfer this class and tujiteke kusawa satu? Tuteke class eno kusawa satu? Say something. Should we transfer this class and we put it at 9? Somebody tell us. What should we do? Okay, let's go ahead. We shall look at it later. I see Aichiba is bringing some money. Let it rally. Now, we are going to discuss what to do after here. Now, let's look at this. We must for us to be successful in trading, we should find a method. You should find a method where we cut our losses. In other words, for us to be profitable in trading, especially in futures trading, in spot trading, you will not make any loss. You will not make any loss in spot. But in futures, losing money is inevitable. It is part of that trading. But you have to cut your losses. You have to cut your losses. You have to cut your losses. You have to cut your what? You have to cut your losses. You have to make sure that you get to know where should you put the stop loss, such that even if you are stopped out, you are stopped out with the less amount. So to be a profitable trader doesn't mean that you will not make any loss. Being a profitable trader means that being a profitable trader means that you are getting more profits, means more profits than losses. More profits than losses. Okay, that's when you become a profitable trader. That when you try to sit down and you count your losses, you count your profits, the profits are more than the losses. The profits are more than the what? They are more than the losses. Fear of incurring major loss. The other type of fear is incurring a major loss. It is done with a stop order. This stop order lets the investor take a comfort that if his appraisal is badly fraud, his loss will be cut short before it becomes a disaster. If a trade has been made too early, the stop may be too close to survive the remaining and unknown action of the trading range. In these cases, the position may be lost to a stop, resulting in a loss, even though the eventual outcome has been properly diagnosed in the market. Using a stop correctly means maintaining a profit risk ratio in your favor. Be careful, however, that you don't end up using this idea in a way that unduly restricts the stock's ability to move. So obanga oteekako stop loss yo, stop loss togiteeka kumpi nnyo. Stop loss togiteeka kumpi nnyo. For example, oyingidde 0.2789. This 89 can be moved by the market within a second. So when you put your stop loss at 0.27, it will always hit it. Okay, don't put it earlier. For Nayengo, making sure I have to set a stop loss. Over the years, we found out that the most generally acceptable profitable ratio is 3-to-1. First of all, it prevents a major loss. If all go in major loss, it also gives the stock some breathing room. It is unreasonable to assume that every stock will be caught exactly as it's done. A long position may move somewhat lower before it turns up, and a short one may move somewhat higher before turning down. You have got to allow some margin for error. So kyekirishe gambit stop loss togiteeka kumpi nnyo. Stop loss order. How to place a stop loss order? Step 1, identify the structure of the markets. Step 2, press your stop loss beyond the structure. Okay, let me explain. Identify the structure of the markets. The market structure refers to support and resistance. Swing high, swing low. Higher highs, higher lows. Lower highs, lower lows. Okay, so that is the market structure. For you to market structure, you can see market structure. Is the market moving up or it is moving down? So if the market may be ranging within the support and resistance, okay, the market may be swinging. We have a swing low and we have a swing high. The market may be having lows, lower highs and lower lows. Okay, lower highs, lower lows. The market may be having lower highs and what? And lower lows. And for that reason, you should be, for example, here, uptrend, price making higher highs and higher lows. Step 2, press your stop loss beyond the structure. There are important points in the market structure, in the market, because that's where most traders will place their stop loss. Why? Because if the price trades beyond it, it will invalidate their trading setup, as they know they are wrong on their trade. But the problem with pressing your stop loss near these levels is that it gets triggered easily by smart money. For example, why they do this? Smart money is paid to correct volume where liquidity is found. He only targets places with higher volumes and he corrects them. How do they do? The spikes in one direction or the other hit the stop losses of either sellers or buyers. For example, for the example here, this is your resistance level and this is your support level. You sell here, you have to sell here, okay? You press your order tight around here. The stop hunt bar hits. Now, teacher, look at this. Let me see how many people are on the call. Let me see how many people on the call. Only 14 people are consuming risk management, but it is okay. For me, let's go ahead. Okay. Unless we make a plan and we say, let's change this lesson. Because why we change the evening lesson, it is because most people could not attend. So if it is possible, we can even change this lesson from 6:30 and put it around 9 when all people are here. Because this is risk management is very, very important in trading. Now, this is our support and this is our resistance. Okay. You have watched your coin moving from support up to the resistance level. You have to make a sell order here. You have to press your sell order. You press your sell order. After pressing your sell order like this, you press the stop loss tight close. You put the stop loss tightly close around there. Okay, tightly close around there. So once you put your stop, you press your sell order, you put the stop loss just above the resistance. If you do that and you put it just above the resistance, smart money will push price and tap your stop loss. Okay, so that's why we are saying that it is not good to just put your stop loss around here. It is not good. Reason being, the smart money will hunt for volume. Will hunt for volume and liquidity and liquidate you. After liquidating you, the market will still go. So not liquidating you, but after hitting your stop loss, the market will still go in your what? In your favor. Most of the people place their stop losses just above the area of interest, okay? Just above their resistance or just below their support area. You understand? And if you do that, just a mere week, like you will look here, this was just a week. It was just a week. So the market will just a week and take you out, and then after it will take you it will go to the direction that you really need. You understand? So that is risk management. So you should know where should you put your stop loss. Make sure that you don't put the stop loss too tight here, because the smart money will fetch that liquidity and take out this liquidity. So that's what, when we look at this, when market, because previous market stopped here, when the previous market stopped here, there is liquidity. Those people who used to, who want to, there are people who wanted to take profit here. There are people who are pressing their stop losses here, we have seen. So smart money will come and see that there are a lot of orders here. So it will tap here and fetch all the orders that are here, and it will continue to its direction. So it means if this wicks here within this range and it finds your stop loss order, it will trigger it. Okay, the stop loss order will be triggered. The stop loss order will be triggered, and after triggering it, it will eventually go into your direction. Simple. Protection against greed. So here we have been protecting against fear. Now we are protecting against greed. Greed is perhaps more basic when it is responsible for a loss. When it is responsible for a loss, it is a loss of already realized profits. From an objective standpoint, you could think that when a reasonable profit has been developed in a position, there could be great satisfaction in taking that profit. Unfortunately, it doesn't always work that way. Let's analyze the situation. After the market is given a certain profit level, there is a tendency to want more, greed, instead of being satisfied. So like what I did yesterday on a certain coin, I made money on the coin around 3 times, and the third time it caught my leg. You understand? It caught my leg, and that is not being good. So once you make profits on a coin, for example, 3 times, please leave the coin to go. After the market is given a certain profit level, there is a tendency to want more. The desire to have more profit causes the situation to be analyzed from the standpoint, greed, and not from the standpoint of things as they really are. At point, greed has taken control, and the profit already gained is jeopardized. So this one is just means to be taken out, right? To lose the money that you have already made. Consider these examples. A stock is in an upward trend and has been for quite some time with good upside progress being the result. There are 2 reasons here for selling this stock. The stock becomes overbought and reaches its upside objective key resistance. Here is an example of risk management in trading. You go long on breakout and the trade goes in your favor immediately. Shortly, you have open profits of 3R. Okay, and your trading strategy tells you to exit your trade because the market has reached a key resistance. But you tell yourself, this chart looks so bullish. I should hold this trade longer for bigger profits. So you hold on to that trade. The market slowly starts to reverse and wipe out some of your open profits. Now you exit the trade if the market increases slightly. Unfortunately, the market didn't go higher and retrace all the way and hit your stop loss. How to overcome greed? Establish or sell or cover order in the area of the anticipated objective. So you establish a sell or a cover order. Yes, establish a sell order around the area where the coin is oversold or overbought. Or once the price is reached in the anticipated objective, tighten your stop loss, trailing stop order. Okay, trailing stop order pre-establish a sell or cover order in the area of anticipated objective. The only way to totally protect oneself from greed is to take steps against it, and the time a position is against it. The only way to totally protect oneself from greed is to take steps against it at the time a position is. One of the best ways to do this is to predetermine and pre-establish a sell or cover order in the area of anticipated objective. When the stock reaches that level, they automatically eliminate the position will be automatically eliminated and the profit protected. Greed won't even have a chance. Trailing stop order. So when you find out that Sorry. So when you find out that you have that problem, you see that the coin has reached the oversold area, or the coin has reached the overbought area, and where this coin has reached the oversold area, you need to go out of the market, and you yourself, you keep saying, no, this trade will do well, okay, this trade will make us money. You see, this trade will go up. This trade has not yet reached that area where it should go down. You understand? So you keep promising yourself. You keep promising what? You keep promising yourself till when you see that it is not yet what? It has not yet protected you. So you find out that you are losing. So make sure here, where you see that the coin has reached maximum support area or maximum resistance area, you set a stop order. You set a stop order such that you eliminate the losses. So we are looking at risk management, and I'm not going to teach too much because most people are not here. Trading stop order. Cut trading stop order, we identify zones where we identify zones we are happy to trade, and then work the best entry we can within the area. Stops should be placed in a location that invalidates the trade. Not every position is going to make it to its indicated objective. I mean, not every position hit the target. In those cases where the ultimate objective is to meet is not met, how to protect the position. The position order can be used very effectively for this type of protection if used correctly throughout the life of position. So sigenda ngenda chikola practically. Trading stop order genda basumbuwa eno gyetuliko eno. Trading stop order egenda basumbuwamu, naye allow me teach this practically, maybe tomorrow. Egenda basumbuwamu. Egenda basumbuwa. Let's go with the stop loss order. Oyiza engeri gyebakola ki, gyebagidownloadingamu, gyebagikozesaamu. Kakati let's say something. Should this class be at 6:30, or we transfer this class from 6:30 to around 9? Let's take our mukono. Let's discuss about that. Should this classroom, all right in the chat, should this classroom remain at 6:30? Should we stay at this time because at 9 we are already at work? Now, look at the class. It is having 15 people. The class is having 15 people. And you're looking at risk management. It means very many people are missing. Give us answers in the chat. Let's discuss. What should we do? Should we, or we remove the class completely? Because for me, I cannot set my alarm and I teach only 15 people. I set an alarm to teach and only 15 people come to class. You see? I set an alarm to teach and only 15 people attend the class. What should we do? Should we put this class?
Madam.
Should we keep the class at 6:30? Or we transfer the class at later hours, like 9? What are you saying? Give us your opinion.
Madam.
Please give us your opinion. Yeah, give us your opinion.
Madam, becoming someone profitable, it requires some time for you to make it. However, not for doing a minimum, ne wetubanga twelumiriza n'onyigiriza n'otuukiriza obudde bw'okujja mu meeting. Kati abalala abataliiwo tetulina kale endowooza zaabwe kuzitegera kuba singa babaddewo baali badde n'ensonga zaabwe ne batugamba tetubeerawo lwa nsonga bweti ne bweti, naye nze ngamba twalisigadde tusoma era mbadde nze nkusaba walisigadde era osomesa ne betulina osoma kubanga bonna tebagenda kujja kubeerawo kubitegeera kubeera mu kiraasi nti no tayimu ezi naffe kennyina babeerawo oluusi tulema bitegeera naye kati wosasira omuntu atabeera mu kiraasi kati nze nsaba twalisigadde ne kiraasi eno wetu kuba ngera bw'ogamba wabeerayo kiraasi za Mr. Kabanda ku ssaawa emu kitundu kati obutanyigiriza kiraasi eyo kugiyingirira twalisigazza kiraasi eno kwezi ssaawa abantu simanyi balala kale kusalawo kwabwe naye nga nze twali badde nze nga nze kye mbadde nsaba kuba okufuna ssente tulina okuteekamu teteri agenda kufuna ssente za kumukeeka tulina okwerumiriza kuba nange kennyini ayogera wano ndi ku mulimu ne bwe mba nga neenyigiriza ne ŋŋamba no ngira bwe nti no kambeere bwe nti nembeeramu mu kiraasi era bwe mba sirina kyengize ne ŋŋamba ekirungi eri recorded kanzireyo ku YouTube maybe bo baddayo ne bakozesa YouTube I don't know bo bayinza okuba baddayo ne bajjayo YouTube ne balaba ku YouTube ne baba nti basomesezza bwe bati ekitali kibi naye nze mbadde nsaba twalizireseeyo gwe n'ogenda n'ennamba gy'olina okugenda nayo kuba ffenna tetusobola kubeeramu ekyo kyo madamu olina okimanya ne bwe tunaziteeka ku ssaawa 3 era ojja kulaba nga bantu era olina abantu 214 abalala bagambe tuli ku mirimu naye tewali budde muntu bw'abeerawo nga tali bize jasi tuwerekereza bwerekereza n'ogamba no kansooke nkole bwe nti n'obeera olw'ogenda ogenda ogamba nedda kanneewogome bwe nti kole bwe nti tewali muntu budde bw'alina buli awo nga tebuli bize I don't think so era olina waba tabulina era ojja kulanga gamba mbadde nina okukola bwe nti buno budde mba ngenda kukola kino mba ntambula teri muntu atalina budde butali bize wendowooza.
All right, thank you very much. Oyo bwatyo bwatesezza agamba classes galao in that we don't inconvenience the 7:30 class of Mr. Kabanda. Let's katuuliza abalala. Kaka kazindalo kwegere.
What's your Madam Prose?
That's bulungi wasoteeyo.
Bulungi nnyo. Kati nange ndi ku mukulu kyagambye tusigale wano eno obutateteganya kiraasi endala kubanga ebyokusoma tulina bingi ate n'abasomesa baki bangi naye oyo ayagala yateekamu amaanyi wabula oyo atayagala era yatali wano ne wetugyongereyo ku ssaawa era 3 kijja sigala kyekimu kubanga naffe tugenda kukola naye nze nemena okulinnya pikipiki endwala gyengenda ne ŋŋamba kantambule butambuzi nsooke ntambule mmaleyo kiraasi eri we nalinnya zira ddala zinsange nga kiri ntuuse gye ŋŋenda so naffe tuteekamu obudde n'ebyokukolera nga tulina kubanga twagala ekyo kye tuliko tukyagala naye atakyagala tugenda kukaka bantu bwekasi tosomesa oli n'ategeera watandika okukola ssente ndowooza ziba ze tezibeera zizo kaakati awo tusigale wano eno abanajja alhamdulillah tujja kujja ekyo munnaaye.
All right, tweyanza. Let's hear from other people. Ladies. Abakyala basirise. Abakyala basirise. Ladies, let's hear from you. Mutesa mutya. Kubanga when I analyzed and I saw that the 6:30 evening class was a bit twabadde tugisomesa nebera abantu 15 ngairawo tulaba wano nengamba no, let's change this class to 9. Now I see people are coming up to 30. Yesterday I saw around 40 people and I was so happy and I said, the Zoom is very important. You understand? Abalala mugamba mutya ku kintu ekyo. Should we transfer the class from 6:30 to 9? All at later hours, such that we all benefit? Because a chapter style class eno ku ssaawa 12 kitundu kwe kubanga people get to work early. So tugamba before we go to work, let's be in class for 1 hour. 6:30, 7:30, simple. What is your opinion, other people? What is your opinion? What do you say about it? We leave it at 6:30. Let's remain 6:30, madam. 6:30. Same time, mama, 6:30. Just to go with the few, they will still come. All right, let's leave it at 6:30, but like risk management. Risk management. This is something that is very crucial. I don't know whether people get time and look at the risk management. Allow me stop here and we attend the 7:30 lesson with Mr. Kawanda. It is very, very crucial. That's why I don't want you to miss. Let's go, please. Those people that have already have the link. Let's share the link to our friends in the Crypto Pioneers group, and we get there as soon as possible. Let's get there as soon as possible because today is Thursday, and I think the man is live. Those people that Zoom is disturbing you, please go to the YouTube channel. He's streaming live. Crypto Ambassadors. And for me, I don't know your program, maybe. I don't know whether your program, maybe we can put another like around 10 a.m. Don't give me another burden. No, we have only one class. I was saying, Abdallah, that should we because right now when I saw only 15 people attending this class, and I was like, should we transfer the same class, the same hours, but we put that session at 10, all at 9? How do you see? So most people say we leave it at 6:30. Please encourage other members to come and attend this class to give us morale, okay? Let's go to the 7:30 session with Mr. Kawanda. See you in the evening. Leader Robert is still taking us through the SMC. You people, if you don't know how to become a profitable trader, Mr. Robert is teaching it very well at 9 o'clock. So at 9 o'clock in the evening, you have a class here. Make sure you attend in person. See you next time. Somebody says, leave it at 6:30. Okay. Let's leave it at 6:30. Encourage other members to come to class and attend. Unless you have any burning problem. Do you have any burning problem? If no, let's go. If you have any burning problem, come on. If you don't have any burning problem, let's go to the 7:30 class. It is streaming live onto the YouTube channel, Crypto Pioneers, Crypto Ambassador.